I think they've got very high rates. They see inflation fading. You are just emerging from a recession, so I think there's no reason not to cut as you're effectively getting closer to 2%. So Habeck was telling us what we already know. They will cut and they have to cut.
It's a bit cheeky though, isn't it? So you've got an economy minister of Europe's most important economy telling us that we've got a rate cut in the bag. I mean, I know, and Karen and I were talking about would we put our mortgage on it? Well, yes, but it's still like, I've never known a situation where everyone knows and they've flagged every single person, whether it's the economy ministers, the prime ministers, the, dare I say it, governing council members. Yeah, it's done. I've never seen forward guidance like it.
But it's because I think economically there's simply a very strong case for this. You had an inflation emergency. You responded to that. That inflation emergency.
You still don't tell everyone in advance you've done it, though, do you?
Yeah. I mean, I'm not sure he's privy to any more information than we. I mean, they are, of course, separate for institutional reasons. They're institutional barriers. I think he's just saying there's a strong economic case. And
every minister we've spoken to in the last couple of months have pretty much told us there's going to be a rate cut anyway, haven't they?
But with caveats. So,
not minister, big part. The governing council member.
I spoke to half of the governing council when I was in Washington. But it was with the caveat, unless something steers us off course, which could have been the geopolitics, right? It could have been anything in this type of environment. So that hasn't happened. But when it comes back to the growth profile, and this was something that I discussed quite a lot with those members, they were concerned, or some of them in particular, concerned about the fading growth picture. Yeah. Is that in the rearview mirror in your view?
We are very much of the view. So I think we have to separate what is the data telling us right now and what is likely going to happen in the future. So you had a recession late last year. PMIs have moved higher. Credit conditions have improved. The credit impulse has improved. So there is a pickup in growth momentum. What we see among our investors that we speak to, they're getting very optimistic about Europe, especially as they see growth in the US fading, and they're extrapolating forward that improvement that we've seen, and we very much disagree. We think growth will weaken in the US. We had a very weak ISM print yesterday. We think there will be more to come of that. And as the weakness spills over into Europe and you get the full impact of all this monetary tightening...
Sebastian, we didn't have a very weak ISM print yesterday. This is where I'm going to get into the weeds, taking on the head of European Equity Strategy at BOA. We had the employment index rising above 50 for the first time since September last year.
That is true.
The highest level since August 2022. Yeah. We had export orders rising above 50. That is not very weak data.
I think what you're doing, Steve, is you're picking the sultanas out of the carrot cage.
That's another conversation. So I'm absolutely picking the sultanas out because there is no weakness at all. This is another conversation. We can do it afterwards if you like, ladies and gentlemen. We've already had this debate off air. In fact, it was a row between me and Karen.
He's keeping the walnuts and he's taking
that is really positive.
Yeah. So,
as I take the sultanas out of the carrot cake.
To go back to our previous conversation, Steve, it's an appetizing cake, but there's a soggy middle, as you would say.
Oh, God, we're going to have to tell them what... Look, OK, let's just tell the viewers what we're talking about. Okay. I made a cake the other day. It was unbelievably tasty, but I took it out of the oven too early. Ergo, the middle of it, as all you great bakers know, it sank, but actually the periphery and the actual taste of it was delicious. Karen doesn't eat sultanas, so she would have been picking them out. Can we stop talking about my rubbish cake?
Let's talk about the ISM. Look at the ISM new orders, the most important driver of underlying demand. It was already weak in April, 49. It's now at 45. 45 is a recession level. You're really counting on a continued overshoot in activity relative to the underlying new orders. Otherwise, you're in a recession.
Yeah, to your point, we did see some four handles on the manufacturing data that crossed from the core countries in Europe. So if there is some urgency in your view for the ECB to be cutting to try and take away that top tier of restriction, is that it? Just one rate cut, or are you recommending a series of cuts here to shore up growth?
I think it basically, both for the equity market and for the economy and for policymakers, it depends. Why are you cutting? Are you just cutting because the inflation emergency is gone, in which case you can be gentle and slow and very deliberate in what you're doing, or will you see the macroeconomy roll over? And of course, we've all been holding our breath for 18 months, waiting for the impact of all this hiking. It hasn't come through. We are arguing it is because you had a lot of fiscal stimulus in the US. That's now rolling off. Monetary policy works with a lag. You're now seeing the full impact with a lag, first in the US, because that's where it started. If monetary tightening still works with the normal lags and you no longer have fiscal protection, there will be more economic weakness coming, and then you will cut with more urgency.